What's going on, guys? Aaron here from Demonetized Capital. Thank you for tuning into the MEDMEN live conference call in about 9 minutes. So we're going to be taking a look, seeing how the conference call goes, how MEDMEN reacts in terms of the price, the stock price. We actually made a quick trade right before the market closed, so we'll be telling you guys all that stuff in 2 seconds. I just need to fire up the chat here, and then we will we'll get straight to things. But it should be interesting. Hope they have a good quarter. And hi, I'm new. Should I buy pure or dump it? Bought at 30 cents. That's a tough one. We'll talk about that in a second. So anybody new to the stream, hit that like button, and we will see how MEDMEN does. I've got the conference call up here, so we'll be taking a look at that in 2 seconds. We're just hanging out in the MEDMEN store right now, if you guys can see. Waiting in a couple minutes. Did you guys buy MEDMEN? What do you think about the stock? We added some right before the market closed, so we'll be talking about that. I don't expect as big of a turnout, but you guys can obviously watch this video on my channel afterwards. So we're just waiting for the earnings call to start at about 5 o'clock. So, alrighty. Let's take a look and see what MEDMEN's doing after hours. Sorry, I'm gonna have to close my Facebook there. We're not seeing much movement after hours. I'll try and refresh it, see if we're getting anything, but seem to get no reaction after hours. Let's see if we can find a better after hours quote for MEDMEN. Alrighty. Not really seeing much. I don't know how good OTC quotes are for MEDMEN after hours. Closed up 0.36%. Where is our after hours trade though? That's what I want. Either way, regardless, guys, I'll stream the conference call. Anybody new to the stream, you guys can see it's right here. We've got the audio webcast ready to go. They've got some opera music playing or some symphony music playing right now. I just don't want to get my stream demonetized. So we'll see. Should have some people tuning in at 5, so that'll be nice. And we can, in the meantime, we've got about 5 minutes, 6 minutes left, so might as well recap the closing numbers. I just dropped a video, your market minute video, so feel free to check that out. And then we'll let you guys know the last trade of the day that we made. So, let's see here. Yeah, I do believe earnings are out for MEDMEN. But the conference call hasn't started yet. The conference call starts at 5. Let's Google though. I did see the report on their website. Here we go. So we'll read the report right before the earnings conference call. So thanks for telling me that. MEDMEN Q2 revenue goes 39% from Q1 to 29.9 million with operating loss of 61 million. MEDMEN reports second quarter fiscal year 2019 results. Increased revenue substantially by 39%. Continued to perform favorably in California, with 8 retail locations reporting a combined 23.7 million in revenue. Increased overall gross profit margin to 53%. Appointed key personnel to the management team, including Michael Kramer as CFO. During the quarter, closed an acquisition of vertically integrated license in Scottsdale, Arizona, and dispensary license in Maryville, California. Our strong second quarter results support MEDMEN's commitment. I hope you guys can see this here. Let me move myself out of the way. Didn't realize that, guys. Whoops. 1 sec. There we go. What's up, Michael? Our strong second quarter results support MedMen's commitment to drive strong retail and sales performance while efficiently scaling the company and executing on our growth strategy. As we emphasized last quarter, we are in a new phase of growth, one focused on continuing to operationalize our industry-leading retail footprint and increasing our profitability. We are confident in the team we've built to drive our success. So look at this stud. CEO and co-founder. What's going on, Errol? I know you just sent me a message on Facebook. Sorry, I had to close it. We've got the conference call here in 4 minutes. So it's all ready to go. I'll turn off the music. We'll tune into the conference call and we'll see how it goes. Still looking for after hours quotes on this stock. Can't really find it. If anybody can find me after hours quotes for MedMen, that'd be sweet. Let's check the NASDAQ. Up 0.61%. MMNFF. But I believe that's just the closing numbers. After hours quote. Here we go. Let's see. Yeah, we can't find much for after hours quotes for MedMen here. Let's see. Nope. Yeah, so we're not going to get after hours quotes, unfortunately. That's all right. We're still going to listen to the conference call. Wonder how long it's going to be. Has after hours? Yeah, I don't know about... It is OTC. I know OTC. I don't know if OTC has after hours, but apparently... I mean, if you look on investing.com, you can find after hours quotes, but it says it's delayed. Otherwise, I think we'd see some data. I don't really think OTC has after hours. So we're gonna check in on this and see if we're still playing opera music here. They love to play opera music in their conference calls. So let's check it out, guys. Yep, still playing opera music. 2 minutes to the conference call. In the meantime, back to the MedMen shop. Back to the MedMen shop we go. Whoa, shoot. That's not what I want. Who's been to a MedMen? I've never been to a MedMen before. Yeah, I like to be creative. I'm just playing around with some stuff. I just dropped a video, your market minute video, recorded it. So we did a few new locations this time. I've been now 3 times in San Diego. How was it? Aaron, what is your take on HLIX? You got 1 minute to take a look at the chart real quick, HLIX, and then we're getting into the conference call. I know you've been talking about this one, Neurosis. Happy to have you here. Happy to have you here. You always find those winners. Those stocks that just seem to explode. 1 minute, 1 minute. Integrated operating environment solutions for the legal cannabis industry. Security, compliance, and technology. Sounds phenomenal and seems like I've missed the boat again. Can you, next time, can you tell me about this stock, like maybe around here or even here? Because you told me about this like a day or 2 ago. It looks like a great stock. Let's see. Still playing opera music. What are we looking at here? Northland Power. Oh my gosh. Canadian Utilities making a 1.68% gain. Yes, sir. Hollywood, California. That's awesome. The time is now, but we're still getting opera music. Yeah. So we'll wait. It's okay. It's okay. It's 5:01. These guys are late. What's going on? Oh, it looks like we're getting something here. Yeah, it looks like we're getting some buffering, so I'm turning this music off right now.
Conclusion of formal remarks. As a reminder, a live audio webcast of the call is available on the Investor Relations section of MedMen's website and will be archived for replay. I'd like to remind everyone that today's call is being recorded. I'll now turn the call over to Stephanie Van Hassel, Head of Investor Relations. Please go ahead.
Here's what we'll do, guys.
Thank you. Good afternoon and welcome, everyone. Today I am joined by MedMen's co-founder and CEO Adam Biermann and CFO Michael Kramer. On today's call, management will provide prepared remarks and then we will open the call to your questions. Chief Corporate Development Officer Zishan Haider will be available to answer questions as well. Earlier today, we issued a press release announcing our results for the fiscal quarter ended December 29, 2018. The press release, along with financial statements and the MD&A, is available on the company's website and filed on SEDAR. Before we begin, I would like to remind you that the comments on today's call will include forward-looking statements, which by their nature involve estimates, projections, goals, forecasts, and assumptions, and are subject to risks and uncertainties that could cause actual results or outcomes to differ materially from those expressed in the forward-looking statements, and certain material factors or assumptions were applied in drawing a conclusion or making a forecast in such statements. Forward-looking statements relate to, among other things, the business and operations of MedMen and PharmaCann, our plans for new stores and other facilities, our financial and operational expectations, the terms, conditions, structuring and timing for completion of acquisitions, and the prospects of MedMen upon completion of the acquisitions. These forward-looking statements speak only as of the date of this conference call and should not be relied upon as predictions of future events.
We're in the back here, though.
Additionally, information about the material factors and assumptions forming the basis of the forward-looking statements and risk factors can be found in MedMen's annual information form dated November 5th, 2018. The management's discussion and analysis for the period ended December 29th, 2018, and press release dated February 27th, 2019, all of which are available under the company's profile on SEDAR. During today's conference call, MedMen will refer to certain non-IFRS measures that do not have any standardized meaning prescribed by IFRS, such as four-wall retail EBITDA, which are defined in the earnings press release issued earlier today. Reconciliations to IFRS measures are contained in the press release and our MD&A. Please note, all financial information is provided in US dollars unless otherwise indicated. With that, I'd like to turn the call over to Adam. Thank you.
Good afternoon, and thank you all for joining us today. I'll start with a brief update on our strategic outlook before passing the call over to our CFO, Michael Kramer.
Bob.
Following Michael's comments, we will answer any questions you may have.
But I'll be quiet.
Fiscal Q2 was another strong quarter of execution for MedMen. We remain laser-focused on our mission to be the leading cannabis retailer in the most strategic markets, operated by the most talented people in the business. Our entire team, from executive management to our best-in-class sales force, is fully engaged in positioning the company for sustainable long-term success. Last quarter, we discussed the start of 3 primary initiatives that will remain core to our business going forward. 1. Continue to operationalize our extensive footprint. As of this call, we have 20 of the 78 licensed stores open and operating as MedMen, underscoring the tremendous opportunity ahead to turn the balance of our retail licenses into revenue-generating storefronts. While California is our primary market, we are especially excited about the opportunity in Florida, where we plan to open our first 12 stores by the end of this calendar year.
I love that they're getting into Florida.
We also have 6 of 17 factories operational.
That's awesome.
And as we bring more factories online, we will gain greater leverage with a wide selection of in-house products. 2. Create higher operational efficiencies by using our scale to our advantage. We will leverage existing corporate infrastructure as we enter new markets, consolidating overlapping functions resulting from M&A activity, and taking advantage of our purchasing power and ramping up our factories. And 3, continue to grow the MedMen retail brand, which has defined the modern cannabis retail experience especially in key markets such as California.
Nice.
The launch of our new Normal campaign earlier this week is a reflection of the role we play in building awareness for our retail brand and changing the narrative around cannabis consumption. Our board continues to bring best-in-class corporate governance and thought leadership to our company. The board's priority continues to be serving the interest of our shareholders. Since going public in May, the board has set up independent committees for audit, compensation, and corporate governance. In terms of our executive team, I could not be prouder of the top-notch talent we've assembled here at MedMen. We are in a constant state of evolution, and we will always put the right people in the right positions to succeed. At times, that requires reassigning people and hiring new talent to help us reach the next big milestone. One of our newest additions is Michael Kramer, our CFO, whom you'll be hearing from shortly. Michael joined us in December and embodies the type of executives we have leading this company. Innovative, strategic, driven, and adaptable, with experience honed at some of the best companies in the world. He has a 30-year track record scaling high-growth businesses at leading retailers like Apple, Abercrombie & Fitch, and Forever 21. Michael has made an immediate impact here at
Hit that
MedMen,
like button, guys.
helping set our forward-looking strategy, which he will discuss in greater detail shortly. We have the right talent, a strong balance sheet, and now the right CFO with the vision and expertise to guide MedMen through this phase of our evolution. And with that, I'll now turn the call over to Michael.
Thank you, Adam. First, I'd like to take a moment to say that I feel incredibly fortunate to join MedMen at this critical moment for the company and the industry. We're making history here, and I'm proud to be part of the team that is leading the charge. When I joined MedMen a few months ago, it was evident to me that the company had begun a new chapter. Today, we are focused on operationalizing MedMen's vast footprint, creating greater efficiencies, and growing our top line. It is clear to me that we need to own our own narrative. Even though MedMen has one of the highest revenue figures out of the U.S. cannabis industry and the most brand equity, it is trading at a significant discount to its peers. Before turning to our second quarter financial results, I'd like to quickly touch on a few operational highlights from the quarter.
Perfect.
One, we closed on our acquisition of licenses in Scottsdale, Arizona and Emeryville, California, which is expected to be operational this year. Second, we increased our footprint in California by acquiring a licensed dispensary in San Jose, MedMen's second retail store in Northern California, and purchased the retail operations and license for a store in Santa Ana, California that was under a management contract. Third, we acquired 2 vertically integrated operations in Arizona, including retail locations in Scottsdale and Tempe, and 25,000 square feet of cultivation and production capacity in Tempe and Phoenix. As you'll see in our financials, we are now basing our accounting on the 454 calendar structure, which is common among retailers, and it ensures sales comparability between years by dividing the year into months based on a 4 weeks, 5 weeks, 4 weeks format. Additionally, and more importantly, we are breaking out our financials by business unit on the MD&A: retail, cultivation and manufacturing, corporate SG&A, and pre-opening expenses. This will allow for a better understanding of our business, its drivers, and the profitability of each business unit. We are essentially building 2 businesses: a retail business, which should be evaluated based on 4-wall economics, and a cultivation and manufacturing business to produce our in-house CPG brands, which should be evaluated based on long-term ROI on the significant investments in our factories and product development. By breaking out corporate SG&A and pre-opening expenses, we will also allow analysts and investors to better assess the cost of our infrastructure, many of which are variable in nature, and expenses related to stores that are currently not operating. Let's start with our retail business. System-wide revenue for the second quarter was $29.9 million, compared to $3.1 million in the same period last year, and $21.5 million in the last quarter. This represents a 39% quarter-over-quarter increase. Revenue is based on the 16 retail stores that were operational at the end of the quarter. Please note that while actual quarterly revenue was close to $30 million, system-wide retail revenue, pro forma for pending acquisitions that have not yet closed, was $49.5 million for the quarter, putting us at a pro forma run rate close to $200 million, assuming revenues remain the same for MedMen and pending acquisitions. Drilling down on the key drivers of retail revenue, I'd like to spend some time focusing in on our California business, which has fueled our top-line growth. It's crucial to isolate the California market because it presents the largest opportunity in cannabis. Our retail locations in California are the most mature and serve as the model for the future retail in other states. Our stores in New York, for example, are part of a restricted medical market that will only start to perform when the state allows adult use sales. Our 8 retail locations in the state of California reported a combined $23.7 million in revenue, which represents a 28% quarter-over-quarter increase, driven by strong month-over-month sales increases in each of our stores, a result of our marketing push in California. As we continue to optimize and create efficiencies, we are targeting a store average of $20 million in revenue in mature markets. It is important to note that with stores operational at the end of the second quarter, MedMen accounted for 7% of all legal sales in California, based on tax data reported by the state. In the second quarter, annualized per square foot revenue was $7,895 across our California stores, which represents a 28% increase over the last quarter. As we've said in the past, these performance metrics far exceed numbers available
like button, guys. Only
for
20
established
likes.
premium retailers such as Tiffany's, Starbucks, and Apple's. In addition to strong revenue growth across our retail portfolio, we are seeing retail gross margins in excess of 52% and four-wall retail EBITDA margins of 17%, which we are extremely pleased with since several stores are still ramping up. For California, in particular, four-wall retail EBITDA margins surpassed 24% for the quarter. For our California stores, we are purchasing all of our product from third-party manufacturers and distributors, which highlights the opportunity to significantly enhance margins once our factory can start producing our own in-house products. While our retail EBITDA margins would be considered best in class for general consumer retail, we are not satisfied. We have identified a number of ways to enhance our four-wall economics and drive store traffic. This includes promotional activities that increase conversion, quick and seamless checkout, a high-demand product mix, and innovative merchandising, among others. Moving on to cultivation and manufacturing. While retail is our core business, we continue to invest in our supply chain. Controlling the supply chain by building our own cultivation and manufacturing facilities is essential to producing consistent products and enhancing overall margins. We prioritized our retail rollout over the past year, given the significant first mover advantage on that side of the industry, but are just now ramping up our cultivation and manufacturing capabilities. We reported a $4.9 million EBITDA loss for cultivation and manufacturing during the quarter. Approximately $4 million is related to costs associated with our first full-scale factory, Project Mustang in Nevada, which has already begun producing our state-made product line. Once our facilities are fully ramped up in each of our core markets, we are expecting to see an attractive return on investment through margin enhancement. As we've stated in the past, our target gross margins for our in-house brands are close to 80% versus the 50% or so we are currently getting by purchasing products from third-party manufacturers. As the mix of the products within our store approaches 50-50, we expect significant margin enhancement for the business as a whole. It's also important to note that the CapEx needs for our cultivation and manufacturing business unit are expected to be significantly reduced by our relationship with Treehouse. The REIT will fund future factory build-outs, which eliminates over $150 million of planned CapEx for us over the next 2 years. Let's move on to our third business unit for reporting purposes, corporate SG&A. In the past, we've grouped all the SG&A together, including costs associated to our retail stores, such as retail payroll. Our reporting for corporate SG&A now only includes corporate infrastructure and growth initiatives such as corporate payroll, sales and marketing, technology, etc. Our EBITDA loss for the quarter across corporate SG&A was $44 million. Of the total expenses, 14.4 was corporate payroll, which included the build-out of several teams within the company, including finance and accounting, digital, business intelligence, and marketing. An important driver of corporate SG&A is marketing. In order to maintain our position as the leading cannabis brand in the world, we have made significant investments in our marketing initiatives. During the quarter, we invested $8.6 million in marketing and branding efforts compared to $4.8 million in the previous quarter. This area has been a strong focus for MedMen, and it's paying off. We've already seen significant return on investment from our data-driven marketing strategy, which includes traditional marketing such as billboards, radio ads, and field marketing, as well as digital campaigns, including the just-released New Normal video directed by Oscar-winning filmmaker Spike Jonze and starring actor Jesse Williams. Our investments in marketing have directly resulted in an increase in store sales and being the leading retailer in California. While we remain focused on the growth of the business, I have instituted a freeze on the budget for SG&A until we institute better processes and efficiencies across the firm. It is also important to note that a significant portion of our corporate SG&A is variable in nature, and we believe we will not have to meaningfully add to our existing corporate infrastructure as we enter into the next phase of growth. The last business unit we are breaking out is pre-opening expenses. We incurred $3 million of pre-opening expenses in Q2, primarily driven by rent expenses of retail stores, cultivation and manufacturing sites, and facilities that are not yet operational. Due to the nature of First Strike and the acceptance of the industry in mainstream banking, we were forced to carry some rent in advance.
Sorry, I didn't see it there.
Overall, we reported gross revenue of $29.9 million, which is up 39% quarter over quarter and up 873% over the second quarter last year. Gross profit for the quarter before biological asset adjustment was $13.3 million versus $0.5 million in the second quarter last year. Gross profit margin in the second quarter after biological asset adjustment was 53% compared with 45% in the first quarter. Given the scale of our operations and the increasing leverage we hold over suppliers, we are confident in our ability to enhance gross margins over time, as we've already seen in California. We recorded a non-cash $2.6 million unrealized gain on the fair value of biological assets in the second quarter related to our cultivation operation. The adjustment is not applicable under U.S. GAAP accounting, but is required under IFRS. Given the inherent subjectivity of this data point, we do not consider this measurement to be a driving factor in the assessment of our business. We will continue to report it as required, but we do not take it into consideration as we manage the day-to-day business. While we discuss the primary drivers of expenses by business unit, it is important to know that also included in the second quarter operating costs was $12.1 million of cash and non-cash stock compensation and employee incentive plans compared to $24.9 million in the previous quarter.
Where are we going next?
$5.4 million for acquisition-related expenses compared to $1.4 million in the previous quarter, and $5.3 million for state, local, and federal taxes compared to $4.7 million in the first quarter of fiscal 2019. Financing costs were $0.6 million for the quarter versus $1.8 million for the previous quarter. Overall, we reported a net loss of $64.6 million in the second quarter, or a 25-cent loss per basic and diluted share attributable to MedMen Enterprises shareholders, based on our weighted average shares outstanding of 74.2 million. The public float as of December 31st.
I've been to Paris.
It's important to note that the exercise of our convertible debt, long-term incentive plans, share units, warrants, and share options are anti-dilutive. This compares to a net loss of $66.5 million in the previous quarter and 27 cents loss per basic and diluted share attributable to MedMen Enterprises shareholders based on our weighted average shares outstanding of 46.9 million.
Don't worry, Departures Capital.
We continue to identify opportunities to unlock operating efficiencies and manage our SG&A load going forward. We remain focused on higher operating margins, stronger EBITDA, and four-wall profitability at the store level. We continue to pursue opportunities that offset incremental costs, including 1, infrastructure and state-of-the-art technology that deliver efficiencies in our retail stores, while allowing our sales teams to offer a personalized experience to customers.
Watch this, guys.
2, cost discipline throughout our corporate, retail, and cultivation operations. 3, increased distribution of higher margin in-house brands as seen with State Made. Our cash burn is improving, and we are committed to being strategic about our SG&A spend. In the early days, the company was focused on ensuring a presence in key states, and we have been wise to invest in infrastructure first. We are confident that our execution at the store level and focus on smart SG&A spend will allow us to deliver profitability and positive cash flow over the long term. Lastly, we continue to look for creative opportunities to strengthen our balance sheet and prudently allocate capital to fund core initiatives that will unlock shareholder value. During fiscal Q2 in early October 2018, we closed a $77.7 million senior secured term loan facility at interest rate of 7.5%. And earlier this month, we announced the partnership with Treehouse Real Estate Investment Trust, a newly formed cannabis REIT. We continue to prove that we can access accretive sources of capital. The REIT will allow MedMen to unlock significant value by spinning out a number of our real estate assets. Subsequent to the quarter end, we announced the closing of the sale of 3 properties to Treehouse REIT for approximately $18 million in net proceeds.
I remember reading
We recently announced that a total of over $50 million would be generated once all of the real estate is spun out.
Honestly, this guy sounds like a badass businessman. This initial and future
transactions not only strengthen our balance sheet by generating cash proceeds and reducing property level debt. It provides us an opportunity to significantly lower our CapEx load, particularly for the most expensive spends, factories, which we project will be reduced by over $150 million over the next 2 years. We are gaining momentum across the business and continue to enter new markets capitalizing on our robust license portfolio. For the current year, 2019, we are slated to open a total of 16 new retail locations, including 12 in Florida, where we are licensed for up to 30 stores. We expect to open the first 4 stores in Florida located in Orlando, West Palm Beach, Key West, and St. Petersburg in the next 90 days. We have 16 additional leases already secured. These stores are in high traffic, underserved locations in key population centers where demand for cannabis is high. We will bring quality products and our best-in-class retail experience to each store. Overall, we are pleased with our performance, but recognize there is far more work to be done, specifically on efficiencies and growing the business. I look forward to updating you on our progress in future quarters. I will now turn it back to Adam for closing remarks.
Thanks, Michael. Before we open up the call to questions, I'd like to briefly address the recent allegations that were made against myself and the company by an ex-employee. The allegations are patently false, and we will be vindicated in court. I've made a comprehensive statement that is now on our website, and I will not be commenting further on the pending litigation.
They're definitely a badass
I'll wrap up with what I believe
company.
Is an important reminder.
So
we are in unprecedented times and are operating at the forefront of this evolving industry.
Lawsuit, yeah.
This year began with Kalen increasing its estimate of annual sales from $75 billion to $80 billion by 2030. We could not be more excited about the opportunities ahead, and we're well equipped to take on the challenges because we have the best team in the world. People like Michael Kramer and the more than 1,100 proud MedMen jacket-wearing employees across the country who wake up every day and show up to fearlessly build the future of cannabis. Operator, we will now open up the call to questions.
At this time, I would like to remind everyone, in order to ask a question, press star, then number 1 on your telephone keypad. We'll pause for just a moment to compile the Q&A roster. Your first question comes from the line of Graham Kreindler with 8 Capital. Your line is open. Graham Kreindler, your line is open.
Yeah, hi. Thanks for taking my question here. First one, I wanted to get some color in terms of company's thoughts on organic growth in California. We've obviously seen the increase for MedMen quarter over quarter and the increase in market share here. Considering some of the challenges that the market as a whole has had for scaling up, and there has been some recent developments with combating some of the illicit market there, what can investors expect over the next couple quarters for organic growth there?
Well, what I would say is that the investment in our awareness and the investment in our education in terms of the stores is continuing to grow, thereby growing this organic growth. Give you a point of reference is from my past life and in most retail, you actually start to see seasonality to where the holiday quarter you see a drop off in the quarter post holiday. We did see the increase in the California market through the holiday, but we have not seen the decrease in the subsequent quarter. So what that tells you is that we're actually seeing real growth within our stores as we continue to invest in education within the store and awareness through our marketing efforts.
Okay, thanks, Michael. And then just on the SG&A freeze that you mentioned earlier, is that freeze on the budget in terms of dollars or as a percentage of sales? How should we be thinking about that?
It's in terms of dollars.
Okay, understood. And then final question here. With the expansion in Florida on the retail side, can you get a quick update here on the cultivation side, how the scale-up is going there in order to supply the expected retail rollout?
Sure. The license that we purchased came with a factory in Eustis, Florida, centrally located in the state outside of Orlando. That factory is fully operational. We have played it out, and we believe that we will be able to supply ourselves with the anticipated store openings that we have here through that factory. We are in the process of making that factory larger, and by the time the next version of the factory is ready, we will have caught up to our supply limits from the factory in its original form. So I guess that's a long way to say we will be able to supply ourselves with the stores that we'll be opening this year, and by the time we get past a place of being able to supply ourselves out of that factory, it will have already been made larger to deal with the extra demand.
Okay, thank you very much.
Thank you.
Your next question comes from Brett Hundley with Seaport Global. Your line is open.
Hey, good afternoon, gentlemen.
Brett.
Good afternoon.
Just want to thank you and commend you for the added disclosure in your MD&A. It's extremely helpful, so thank you for that. Michael, did I hear you correctly in your prepared remarks that basically you're heading towards a 50-50 mix between retail and cultivation/manufacturing? And if I did hear that correctly, should we expect most of that cultivation manufacturing revenue to be pushed into retail, vertically instead of outside the company? That's the first part of my question. And then related, you talked about the differing margin structure between the two, 80% versus 50%. Should we expect the company, all else equal, to trend up from its 50% level, towards that number if and as you make headway on your 50-50 mix?
Yeah, the reference in terms of the remarks earlier were in terms of the assortment within the store, where we're hoping to see roughly around 50% of our assortment be what we're going to call our own product, the other 50% be third party. I think it's actually important, even though it's from a margin perspective dilutive, that we do have third party so that we're kind of constantly moving and shaking with cool, hip, new ideas in terms of the product. But the company-owned portion in terms of our assortment is obviously going to be very accretive to us in terms of margin. And we're shooting for the 50-50 split. We think that right now we're targeting with regards to our own product, moving from right now we're running a 50 to 54% product margin. We think that can increase to 80% for the 50% of the assortment that's ours. Now, going forward, obviously it'll be eliminated in terms of consolidation, but in terms of the business unit reporting, which I'm glad you called that out, because I think that's very instrumental in understanding our business, is going forward, all those states that we're actually providing profit from our own facilities, there will be a transfer of cost at a standard cost at third-party pricing, so that we can actually view market to market consistently from a margin perspective. Hopefully that answered your question.
Yeah, that's very clear. Thank you. Another question I had was related to your operating expense percentage for retail as a whole versus California. So your OpEx percentage inside California was, close to 27% for the quarter, and then your OpEx percentage for retail as a whole is, 900 basis points higher, around 36%. Can you just detail a little bit of the differences between the two, and whether or not that gap can be closed in coming quarters or coming years?
Absolutely. It's a great question. And quite frankly, I'm excited to answer that question, because I think the difference is primarily top line. And one of the things that we're incredibly proud of in terms of our California market is our four-wall economics, in terms of throwing off around 24% EBITDA. Clearly that was diluted by non-California stores down to about 17%, i.e. top line and OpEx. But what I'll tell you is that I think part of it has to do with the maturity of the market, maturity of the stores. But what is very exciting is the fact that we're starting to see volumes in Nevada commensurate with our average California volumes. So not only do we have a proof of concept in terms of economics in California, our first and most mature market, but we're starting to see that evolve in our secondary market. And man, I hope we can do that as well in Florida.
That's ensuring.
That's great. And related, this will be my final question. I
gotta agree with you.
I wanted to talk cash conversion with you, Michael, and Adam and Zishan, feel free to jump in here. But
Michael
what
Kramer,
I wanted to discuss was the existing business pro forma for PharmaCann, with a focus on cash conversion in 2020, right? Like getting through the CFO and CFI portions of the cash flow statement without needing that financing section. And so as you guys have set this business, and you talked about freezing SG&A, and that was one of the levers that I wanted to talk about. But when I think about setting up my own model for 2020, the main levers that I'm looking at is what kind of operating leverage can you guys get, number one, and then number two, what can you deliver on that, forward per store revenue line? Because your California stores are putting up really nice numbers from an annualized revenue standpoint, and you just mentioned how Nevada may be well on its way too. But as you incorporate PharmaCann and as you move into some of these other states that are just med, at least in my model, I'm really being careful about the type of annualized per store revenue that I put into your financial model. And so I wanted to get your feedback on what you think you can do, and maybe some of the qualifiers around that from a revenue standpoint per store, and then talk about that operating leverage just going forward. Like if we move from 2019 to 2020, can you guys see SG&A hold flat while you materially expand the top line? So I hope all that makes sense, and thanks for taking my questions.
Sure. Can you just ask it again? We missed it. I'll take the easier part. I'll let Kramer do the heavy lifting. We firmly believe that there is a future where this $20 million number as a run rate per store will be our number system-wide, including all states, including the states where PharmaCann is. I mean, as we look at the states where PharmaCann's in, like Illinois, there's a clear path to recreational sales in that state. You can do everything up to call it imminent. You talk about New York where PharmaCann is, same answer. And even in states where it's not like Maryland or Ohio, we do believe that there is a recreational future in those markets. So, this $20 million number, even though today it's only in California where we're doing those numbers, we believe in California there's a ton more juice there. I always love reminding people we're doing these numbers, which are best in the world, four-wall numbers for retailer, without taking credit cards. Like, we don't process credit cards, and these are our numbers. What will our numbers be when we can process credit cards? You mentioned, the black market or, illicit market, the illegal stores. The illegal stores still exist in California. We said that we did 7% of all the legal sales in the state of California in this quarter with only 8 stores open. We will have, 15 or 20 stores in California by the time anyone can blink. We had no Northern California presence, and we did that number. But let's say we get to 10%, 15% market share in the state. Kalen projects this state to be $10+ billion. And if you back out through that math, we're doing well above this $20 million number per store. The store that we have in Las Vegas, the closest store to Mccarran Airport, which is connected to the highest grossing liquor store in Las Vegas. That store's open 24 hours a day. It's only been open a few months. That store will do well above the $20 million number at maturity. So not that every store will do $20 million across the board, but our target is to have our average run rate per store in our system eventually get to that number.
Yeah, I'll speak to the leverage piece. I mean, clearly one of the benefits of this infrastructure build and investment that Adam and company have done prior to me coming here is our ability to leverage that infrastructure, go forward in the next phase of growth, and that includes acquisitions. Clearly, we will be working through with PharmaCann in terms of the consolidation, but we fully believe that there will be a significant amount of leverage. And as I've stated before, I do not anticipate over the near term future that our SG&A on a dollar basis will grow significantly. So the other thing that I'll add on to what Adam said in terms of the sales is, clearly, guys, part of, even with the phenomenal performance that we're providing here in California, our sales have been stunted somewhat by even, the demand is far exceeding some of the supply in some of our assortment, and we're working with our vendor base over time to make sure that doesn't happen in the future as well. Secondly, I'm really excited about Florida, largely because as I see the pipeline of the stores and the economics as we go into Florida, and keep in mind it is medicinal market only, but based on the performance that we're looking at right now, and I feel really comfortable with this, is that there's going to be a very nice return on investment at the medical only volumes. So that just means once it turns to adult use that there's significant upside in our return, but it will have a return, a significant positive return, even medical only.
Thanks so much.
Your next question comes from Matt Bottomley with Canaccord Genuity. Your line is open.
Afternoon, everyone. Thanks for taking questions. I promise I'll try and keep this concise. Maybe just on the pro forma side of things. So, there's a good chunk of what was reported both in your pre-release and today. About $20 million worth of revenue is pro forma. I imagine a lot of that comes from PharmaCann. So can you give any granularity on what the growth profile is of that subset? I know because PharmaCann itself has exposure to a lot of states, there could very well be step function growth in various states that could come on as opposed to a modest to a moderate growth rate. So any more color on that would be helpful.
Yeah, hey, this is Zishan Hyder. So on the pro forma revenue that we announced, including the pending acquisitions, PharmaCann was part of that 20 million or so, but they were less than half of that number. The majority of that number came from some of the other deals that we've announced and acquired, most notably in Arizona. So and all those assets that we acquired, those were the numbers that they did in calendar Q4, and we're starting to see significant increases in those numbers as well as we get through these months.
Okay, that's helpful. And is there any part of the PharmaCann side of things, because I know they had access to, I forget the specific number, but I think it was 6 states or more. Are there any states that are expected to come on in a meaningful way, let's say in the next 2 to 4 quarters?
Yeah, I think in the next 2 to 4 quarters, the state that we're focused on more with respect to the PharmaCann assets are their Illinois stores. As that program ramps up, I think that's kind of where we're going to see most of the growth. In addition to Illinois, I think Massachusetts is another one where PharmaCann has one of the operating recreational stores in that state. We're seeing great kind of numbers coming out of that store. So I think those are the 2 states near term that we're most focused on for PharmaCann.
Okay, appreciate that. And just second question, moving on just to the inflection towards profitability. I know it's the market opportunity that's about to come up in all the states you're in is much more attractive than any near-term drag on profitability. But considering what's on your balance sheet today and what you need to do over the, again, 2 to 4 quarters, do you guys believe there's a potential funding gap, or do you think you have the resources in other ancillaries, such as what you're doing in real estate, to cover any potential gap there in the short term?
At this time, we are well capitalized, but we'll remain opportunistic with respect to raising capital going forward. And I mean, you alluded to it, but you teed me up, so I'll hit the pitch. It's a once in a generation opportunity to build the biggest cannabis company in the world, and there's outsized returns still very much available for us. So look, even in California, we have an established dominant position in California, already on track to replicate that success in other markets, but there's still a long way to go, and expanding our footprint and investing in infrastructure will likely require additional capital. So that being said, we have been successful in raising capital that is in the best interest of our shareholders, which most recently was highlighted with our partnership with Treehouse.
Great, thank you. And just last question on my end. I think I might have asked this last quarter as well, but just would be interested in an update on what you're seeing, given the insights you guys have in particularly the California or Los Angeles market, in terms of what seems to be selling now, whether it comes to brands or product categories. That might be something you'd like to get into more, whether it be through M&A or whether through your own vertically integrated model through StateMade, that you think you're getting insights on based on consumer behaviors in the first, call it 12 to 15 months here of the rec market in California. And I'll leave it there. Thanks.
Yeah, so this is Zishan again. So on the product brands, I think, one of the valuable parts about our assets in California is the data that we get on different products that are selling in our stores. One of the things that we've known for quite some time is that consumers right now in this industry don't have any loyalty or preference for specific product brands. They're relying a lot on what our sales associates are telling them in the stores, given how new this industry is. So our focus is going to be more on rolling out our own in-house brands. We're obviously partnered with local manufacturers in each of our stores, but for the most part, our brand strategy will kind of rest on our own products being pushed out through our stores.
Thanks, guys.
Your next question comes from Jesse Pitlack with Cormark. Your line is open.
Hey, good afternoon, guys. Just first question, just to kind of add to the questions that Matt had on PharmaCann. Just wondering if you have any updates in terms of the timing, in terms of when you expect that to maybe close.
It's continuing to progress. It will be. It's moving forward as outlined in our December 24th, 2018 media release. It's really just about obtaining regulatory approvals. So we expect to release a circular with further info within fiscal Q4 2019. But I can tell you that both organizations have put a working group together and are working hard and pushing hard to get it closed sooner than later.
Okay, and just kind of based on how things are coming together, do you see it as closing all together in lockstep, or is there chances that certain states will close and you'll be able to start kind of bring some of that revenue in, or is it going to be all together?
Yeah, no, definitely rolling closings. It's outlined when we announced the definitive deal at the end of calendar last year as to how that was going to work. But yes, we're going to have rolling closings from the time that we get the initial regulatory approvals from the initial states.
Okay, perfect. And then just on the SG&A freeze, can you just kind of confirm when that was instituted? Was that at the start of the current quarter, or is that just partway through the quarter?
That was actually instituted a couple weeks ago, so you'll see the effect of that, probably, a third of this particular quarter and go forward.
Okay. That's all for me. Thanks, guys.
Your next question comes from the line of Paul Penny with Northland Securities. Your line is open.
Good afternoon, guys. This is Greg on for Paul. Thanks for taking the questions. First one for Adam. So, we've seen the broader publicly traded cannabis names improving or at least having steady share prices, while MedMen shares have kind of been stuck in neutral. So with that, we'd just love kind of your opinion or your view on what the biggest misconceptions about MedMen today are.
Excuse me, guys.
Hi, Paul. Good to talk to you. Thanks for asking the question.
This guy's a loud one, eh?
I mean, I guess the only thing I can say to that, Paul, would be it's on us. We have not done a good job of being clear, being concise, and owning our own narrative. Going forward, that all changes. This means making a concerted effort to make sure that the world understands our story so people can analyze and decide if they want to invest in us based on facts. The facts are pretty straightforward for me. Retail is the choking point for the entire supply chain and the most defensible part of this industry. We have secured the best retail locations in the biggest cannabis markets in the world, including the biggest, California, the prize of the industry, where as of this quarter we had 7% market share. And we remain heads down on execution, and over time our stock price will reflect our best-in-class performance. But it's on us, Paul, and we're committed to spending one-on-one time with each of you to clarify our narrative, if that be helpful. Michael especially will start being overly communicative so you can understand MedMen better at both the corporate level and the four-wall level. And at the end of the day, we will be judged on our business fundamentals, and our business fundamentals are best in class.
Awesome, thanks. Second one for Michael here. Just to follow up on the SG&A expenses, maybe looking more long term. We do understand near term it's early stage growth company, and I think G&A has been kind of a catch-all for a wide range of expenses in the past. But going forward and maybe on a fully stabilized basis, where do you see SG&A as a percentage of revenues?
Well, clearly we're going to be leveraging it. We haven't really kind of dictated out the cadence with regards to the growth in terms of top line. Clearly if over the next 4 quarters we're not adding dollars to it, there's going to be a significant amount of leverage given the store count that we've highlighted to you for the balance of the calendar year. And really kind of that's really kind of all we want to commit to right now. Clearly, when we see these exponential growths, in the next couple of years, there will be some incremental investment. We're really trying and shooting for keeping it to a minimum. But more importantly, on a near-term basis, we feel confident that our spending is pretty stable. We understand, quite frankly, that there are areas where there are optimization needs, but there are other areas in terms of investment spending. So hopefully that answered your question.
Yes, that's helpful, thanks. And then just one more from me. If you could just provide an update on the California market. First, in terms of shutting down illegal and illicit stores, and then second, on the West Hollywood store, congrats on getting the license there.
Yeah, I agree with Florida for sure.
But could you provide maybe detail on what the next step here is to obtain a long-term solution?
Florida is a big one.
Sure. Well, on the on the illegal stores, they still exist. They still persist. When we first went public, I remember going on the roadshow, and I could have sworn up and down to anybody who would have asked me my opinion that within the first 12 months of the legal program coming online, that the state would shut down the illegal operators. It just made perfect common sense, and it was what was being promised by the regulators. It hasn't happened. So, as Michael discusses the upside in our business, I always get hung up on, we don't take credit cards, and we're the best performing retailer in the world. Another thing you could get excited about is, we had 7% market share of all the legal market, but out of the entire market, there was a big percentage of those dollars that was spent at illegal stores. When they no longer have an opportunity to spend those dollars at the illegal stores, how much of the total market will we have? So it's something that continues to persist, and we just have to continue to lean on these regulators. They can't allow it to go on forever. They have never done that in any other industry, and we don't certainly anticipate them doing it for the first time in history with this one. In regards to West Hollywood, thanks Paul for following it closely enough and recognizing that we got our license extended through the end of 2019. For those that aren't aware, our West Hollywood store, that license has been there for almost 10 years. That store has been the store in West Hollywood, won all of the awards from the city. It's in the city's materials that they put out for tourism. We employ a lot of people. Those are union jobs. And we've been servicing that community, in a really upstanding way for a long time. That being said, the city of West Hollywood went through that process where they issued 8 permanent recreational licenses and did not give any of them to the 4 pre-existing medical operators, ourselves included. There was a lot of noise around that, and we were overwhelmed by the support we received from our customers, from our neighbors, and from local community leaders. And because of that support, our license was extended now until the end of the year, and we remain really confident about a permanent solution with the city.
Good to hear. Thanks.
It's getting dark in here.
There are no further questions at this time. I will now turn the call back over to Mr. Adam Biermann.
Let's wrap this up.
Thanks, everybody, for continuing to be a part of this journey. We look forward to talking to you all soon. Have a good rest of your day.
This concludes today's conference call. You may now disconnect.
No. Okay, guys, so that's pretty much it for the conference call. I just didn't want to get demonetized with that opera music. So what did you guys think about the conference call, and what do you think is going to happen to MedMen tomorrow? Everyone wants West Hollywood for the money. What brands are going to play there, though? Yeah, not sure. We're getting super dark in here, so let me just turn on a light real quick. Hopefully you guys can see me, as you guys can see that green screen starting to show. So let's see. This should help us out a bit, but I'll be a lot more, I don't know. Maybe we'll move this around a little bit. Sounds like a solid long-term play. Good question. Do you think we will see green tomorrow or a dip? Hard to say. It's not like they were reporting this amazing accomplishment, but I think the company's going in the right track. So I think we could see a mild green day tomorrow. They were very confident, well-spoken, and that's something that I do like to see. And I like the retail aspect and the fact they're getting into Florida, all that kind of stuff. So it's hard to say. Hard to say. Man, you're right. I gotta just go ahead and make that hard to say shirt, because that's my catchphrase, apparently. Thank you for pointing that out, Matt. So we're here at the MedMen office. I designed our little office, just trying to be a little bit creative. We got our speaker set up. One second, I think I'm a little bit too big for this desk, though. There we go. So we can take a look at a few more stocks if you want. I'll stay for, let's see, what time is it now, guys? It is, oh shoot, I'm just trying to see how long we've been streaming for. Oh shoot, here we go. An hour and 4 minutes. So we'll go for like another 5 or 10 minutes. We can do our own Q&A. Agreed. So yeah, so Suniva dumped a bit today. Let's take a look at a few things quickly. I'll switch us to the markets, and we'll get rid of this speaker. I don't need that speaker in there, just a video capture. And now I need to switch myself around. Oh no, there we go, guys. Sorry about that. Video capture, perfect. We're still with you. All right, so my only concern with them are people don't pay a premium to go to an Apple type store for cannabis outside of certain regions. That's true, that's a valid concern. All right, so let's go straight to investing.com. What do you take of the earnings? I think it's good. They showed lots of confidence in the company in the quarter and in the quarters to come. So with their new management, it was definitely positive. I mean, you think tomorrow will be red? I think I don't know. We'll see. I don't necessarily think it's going to be red, but let's take a look at the current stock price. Yeah, I don't think we get any movement after hours. I wish the stock was on like the NASDAQ or the NYSE. We could get after hours movement, but we get absolutely no data. So let's take a look at MedMen on the Canadian side. You know what's funny, guys? More people joined the room after they stopped talking. Like, we're almost at 100 people now. That's hilarious. Smash that like button, guys. We've only got 56 likes. Maybe we can get this to over 100 people. And I'll stay on for a little bit more. Can't be on big boards as they operate in the USA. That is true. That is true. That's true. That's right, actually. Thanks for pointing that out. But yeah, so the last month, the stock did run up a little bit. Currently trading at 431, closed the day at 0.47%. So we actually picked up just a few more shares at about, what was it today? 427, something like that. 427 right before the close. So I'm good with it, whether it goes either way. I believe our average now is just below $4 for MedMen. So we bought it 3 or 4 times already. So that's my exposure in the cannabis portfolio to the US market. Let's take a quick look at Suniva. Suniva has been pulling back a little bit. If it keeps declining, man. If we dip below $5, might add a little bit more to Suniva. Even ACB had a red day today. If they want to be a retail and an LP, how far behind are they from their peers? That's my thing. Good point. Good point, good point. All right, guys, so we'll take a few more requests, comments, suggestions. Feel free to request anything. I've been shifting to U.S. companies. Just bought a bunch of MJARF, sold my ACB and Canopy. Daniel Doss. I agree. We've been, in terms of new investments, we have been shifting to U.S. companies. Sold Aphria, so that was like biggest recent sell in the cannabis sector, and bought Suniva, MedMen, and what was the other ones we bought? A little bit of Oxy and FSD, but just because I feel like they're cheap. Ignite International Brands. Punisher Fitness. How did that stock do today? I didn't even check in on it. It had a tremendous run yesterday. My comments about this stock were, though, overhyped, pump and dump, and we just need to wait for some more stability. I heard if you got to follow Dan Bilzerian on Instagram before you invest in the stock or your order gets rejected. Just kidding. Yeah, we didn't sell any Aurora, but we sold Aphria. Let's see what Aphria is currently trading at. Aphria is trading at 13.37, so the stock's looking good. It's looking all right, looking stable, but I sold it at 14.02, so I'm still happy with that. Punisher Fitness. Do you have what do you own the shares at? You don't have to share if you don't want to. It's okay. If you bought it like right when it IPO'd and you're down on it, it's all good. You can keep it to yourself. Just curious. Just curious. I got 145 Aphria and want them to get a deal at Kronos. I think it could happen, but short term, we had more than enough of ACB. So for me, for now, the sell on Kronos the sell on Aphria was justified. Thoughts on CanTrust? I think CanTrust is a phenomenal company. Too high for me to buy it right now. The stock's done well. I mean, since listing on the New York Stock Exchange, it didn't fall like a brick just yet, so that's good to know. Didn't get attacked by any short sellers. Hasn't really benefited. It's benefited from the listing indirectly, as in it ran up to the listing date. So yeah, I feel like CanTrust currently, right now where we're at for CanTrust, we're going to say it. It's hard to say, but I wouldn't be buying at close to our 52-week highs. Currently we're at 12, 52-week high of 15, I know. 52-week high of 15, but that's on a spike, so right now I'd be a little cautious on CanTrust. 266. Okay, what's going on, Armando? Micron Waste Management or Micron Waste Technologies? Oh, MWM. MWM, sorry, I'll take a look right now. MWM. We're getting a little bit of this green screen action in the bottom here. Micron. Yeah, Micron Waste Technologies. I've been following this stock for a while. I think that the waste management aspect of the cannabis industry is going to be huge, and it's a niche, and these companies are going to do well. Aurora Cannabis already owns a portion of this company, I believe. So I think that's good. At 40 cents, maybe a small position. I could justify a small position at 40 cents, but I also think that it could sell off a little bit further, potentially to its lows. Penny stocks are volatile. Like, for example, if I was looking at Micron Waste Technologies, let's say I had $2,500 to spend. Maybe I'd do $12.50 now. Then if it drops to, let's say, 25 cents, I'd average down. Maybe at 20 cents. So if I was down 50% at one point, average down. It's hard to say. Right now, I think we're in the middle. Could go one way or the other. If you bought that $12.50 and it went up to 60 cents, it's a good hold. And if it went down, double down. That's what I do. So, whoa. Where are my comments? Come on, guys. Waylon, please. Used to buy tens of thousands, recently been buying in hundreds. Why can't bills be dominant across USA? Guys, top 30 or so most followed people on Instagram. That is one thing. He's got a very good following. So, but don't forget, that could be the reason why the stock was so overhyped and then it came down. Because everybody's like, oh my gosh, Dan Bilzerian stock, buy it, buy it, buy it, buy it, buy it. Then it IPOs and it tanks, right? So you can look at it from two ways. Now maybe he can pump it back up. He's got the potential to pump that stock like no tomorrow. He's got money. He's the king of attention and media. So you can almost control his stock in a way. So like I'm sure you made a ton of money on that IPO and then it just tanked. So like I said, I would wait till it stabilizes and then he wants to bring the stock back up. Yeah, it's not like Tilray's IPO at $22. Is Wayland a good buy? We hold some Wayland, down substantially on Wayland. Not a big position, but still enough to get pissed off. Let's take a look at Wayland. 99 cents today. Oh boy. See, like I said, guys, I got questions about Wayland. What's going on with Wayland? I said we're downtrending when we hit like $1.20. Said could potentially go back down to 90 cents. So right now, Wayland looks to continue the downtrend. I would wait to see a double bottom. I don't know where it's going. They could potentially get bought out if the stock gets cheap enough. But right now, I think they're just going to keep downtrending, potentially see a double bottom at 90 cents. I mean, they've got some good assets. They've got some good management, but it's hard to, some of these stocks downtrend so hard. This one, MYM Nutraceuticals. I think MYM Nutraceuticals could be back in a downtrend. We're not really feeling too great after that recent pop. The stock looks like it's losing some momentum. Couldn't hold on to 60 cents. So we could see 40 cents again. If we go to like 55 cents, I might just cut that one position that I recently bought. I didn't buy a big position, but I bought a position at 44 cents. So might take a 10-cent gain on that and just get rid of it. Wait for it to drop back down to 44 cents. Maybe I'll buy some more. Hard to say. IGC's a scam. Stay away from it. Can't trust that company right now. Namaste. Another one, guys. Namaste. So many of these companies. Here. Namaste. And Namaste looks to be, I don't know, guys. Looks like we could potentially hold $1. So what I'm watching right now is if we're going to hold $1 or not. Recently picked some up at 92 cents. I believe they went that low. 90, yeah. Bought some at 92 cents. The next day it popped. So far we've just been kind of treading water. You know, Namaste is one that we've actually never traded or never sold. All we've done is bought it. Bought it cheap at like $1.50, somewhere in and around here. Watched it go all the way up to $3, didn't sell it. Watched it go all the way down to 84 cents. So, hard to say. Hard to say, Matt. Hard to say. Anyways. Shopify. Hempco. I'm going to take 2 more requests and then I'm getting out of here, guys. Got to do a bunch of stuff. Hit the gym. Hopefully it stops snowing. It's crazy. Got to eat something. Been going all day since I woke up, even though I slept in. I slept in and I woke up to a storm. Woke up to a storm outside and I woke up to a storm of work here. So let's hope that MEDMEN trade plays off tomorrow. We're hoping for a green day in the markets for MEDMEN. Personally, guys, I feel confident about management. They sound like they know what they're doing, even if they're a little bit full of BS. Not that I'm saying I think they're full of BS, but they know how to talk the talk, and let's see some results. But that's very important for public relations and investor confidence, is to have good speakers, and I do feel like MEDMEN's management, I'll give them a thumbs up for that for sure. MEDMEN's management knows how to deliver a presentation. So, good stuff. Anyways, we're going to look at Hempco now. Hempco, down 1.92%. Honestly, this looks like we're testing some heavy support, but the chart looks awesome. Steady downtrend though, I'd be very careful with that. This looks like, once again, this is a chart where I like risks. Actually, I like a chart like this. I'm a big believer in, you know, when I buy, then the stock's going to turn around. I just always like to think that way, whether that's not always a good way to think. But right now, I feel like Hempco could go one of two ways. It could continue the downtrend if we take a look at this, you know, potentially sell down to 80 cents. It could crash and burn. Not completely, maybe 40, 50 cents. So I'd see a 50% downside, but we could see a nice little spike. Although the problem with this is the run-ups have gotten smaller and smaller and smaller. So I would like to see some consolidation first before buying this. Because right now it looks like we're just teetering. And we could just continue that downtrend to like 85, 75, you know, just slowly going down. Not to compare these two companies, but look at how many times you could have said this for MYM Nutraceuticals. This is just such a perfect company to show how long a company can stay in a downtrend. But like, okay, so say we're here for Hempco. Downtrend, downtrend, downtrend. Oh, I can't see it going much lower than that, guys. Bam. We lost 50%. So I'd like to see some consolidation first. But Hempco is a very interesting one. I definitely like that. So I'm going to actually add that to the watch list. I think we're watching it. We're already watching it, so. Let's see, I thought you said 10 to 20 on it. That's why. Let me check comments real quick. Holy. If you're in on a pump and sell off, go for it. Make that money. But he predicted Wayland has garbage company after they refused to respond to numerous comments. I know Kevin had a lot of Wayland at one point. I'm hoping for green MedMen tomorrow, but this report sounded future investment focused. Yes, it did. It did sound very future investment focused. Can't predict future Punisher, or was it ACB? Lots of red days. Are we going to see green days? But it wouldn't surprise me. Bill's going 10 to 20 in 2019. They could pump it back up. So like I said, just as fast as it falls, you could pump it. You trim any positions? Didn't trim any positions. I will let you guys know one stock we sold today. The volume indicator for Hempco. Yeah, the volume is an indicator for Hempco. Let's see. We are seeing a spike in volume, but declining volume now. Cannabis bombs are really effective. My wife's red eyes went away after 2 days. Evenco is a good value investment. I've had it for 6 months. Definitely like Evenco for 2019. And today, we made one trade. Eve and Co. I don't know if that's... Don't know why I can't find it. There we go, Evenco. We'll let you guys know the one sell that we did make today. All right, 1 month chart for Evenco. Looking pretty nice and stable. Looks like there could still be lots of value there. So very interesting company. So Pure Global Cannabis. Took our profits on Pure today. I was a little hesitant, but I do feel like this stock could potentially be resuming the downtrend. We lost the hype after the license. I didn't sell it at 30 cents. Kind of regret it. Still took a 20% profit on the trade, and it was only a 3-month trade, so I'm willing to accept that. And yeah, it's hard to say. I feel like Pure could potentially sell off, continue to sell off a little bit more. Steve Wilson, what's up? I don't look at Aphria Health because it's... Let's see. Well, this is the last stock we're going to look at. Much love from Montreal. What's up? Aphria Health's making a nice little pullback today. I like Aphria Health better at $2. Said that for a long time. So if we make it back to $2, I'll look at it again. No problem, Lucas. So it was a very good conference call. I mean, I liked it. Feel free to check out the stream. I'm gonna end this stream so you can watch the recording. As the longer I wait, it'll drop to my channel. And we're losing the background here, guys. It's getting too dark in here. So the green screen is losing some of its effects. So I'm gonna head out. Thank you so much for tuning into the stream. As always, guys, we had an awesome stream earlier in the day. You guys are super supportive. Let's hope for a green day for MedMen tomorrow, a green day for the markets. And that's it for today, guys. So thank you for tuning in. We'll see you guys soon.